Welcome, everybody. It's my pleasure today to introduce Dr. William Morokoff from Standard & Poor's. What's the whole name? Standard & Poor's
Rating Services.
Rating, okay. Yeah, up there. Well, Dr. Morokoff is right now the managing director of Standard & Poor's, responsible for all the quantitative research, right? Quantitative analytics and research group. And he has a background in mathematics and in particular numerical analysis. And we have some overlapping at UCLA. You finished a degree there, but you got a degree from NYU, right? Afterwards, you went to work for the industry?
I did 5 years of postdoc.
Oh, 5-year postdoc in mathematics, and then for the industry, first with KMV, I guess, right?
Yeah, actually, no, first Goldman Sachs.
Oh, sorry about that. First Goldman Sachs, and then with KMV, and then finally end up in the Standard & Poor's. And the topic we will talk about today is new performance measures for credit risk models. Please. Yeah.
Okay, great. Excellent. Thank you very much. Thank you. So it's a real pleasure to be here, and thank you very much for setting this up and arranging this. So as Lixian mentioned, I've been working in quantitative finance now for, I guess, about 20 years. And before that, I was doing Monte Carlo simulation, not at all in finance, but in fact, I worked on what's called quasi-Monte Carlo simulation. That was my thesis. And had an interesting experience, which was while I was at UCLA doing a postdoc, I overheard someone speaking out of Professor Stan Osher's office, famous professor at UCLA. And there was a guy visiting him saying, well, what we're really interested in finance is quasi-Monte Carlo. And it's quite a rare experience to hear someone in an office say, what we're really interested in the industry is exactly what you did your thesis on. So I went in and talked to him, and that's how I ended up getting into quantitative finance. And from there, I went on and worked in risk management at Goldman Sachs, then switched to credit at KMV, which was then bought by Moody's. So it's now Moody's Analytics, or what's Moody's KMV, which focused on probability default modeling for companies. And that's when I got into credit. Eventually I went to S&P. And S&P is a rating agency, which again is very focused on credit quality. And so we're also very interested in both fundamental credit analysis that backs the ratings, as well as using models that are based on market data, in particular equity market data, or also CDS and so forth. But we use these models to help in the surveillance of companies and track what the market's views of companies are, to help inform what our ratings analysts are looking at from a surveillance perspective, so they can more easily track how different views of how companies are doing. But there's a really interesting question behind these models, which is how well do you track them, or how do you measure how well these credit models are working? And that's what I'd like to talk to you today about. Okay, so, but I assume that most of you haven't spent the last 20 years focusing on credit risk and credit risk modeling. So I thought it might be good to give an overview of what credit risk is, and give you some background on first what we're trying to do with it and what is credit overall, and then take a look at some credit risk models, specifically corporate firm probability default models. That is, models that help predict the likelihood that a company will default. And then from there, ask the question, okay, well, how do you measure the performance of these models? Consider how you might evaluate the performance, and then consider some ideas on new ways to measure the performance. Okay, so first, the overview of credit risk. All right, so what is credit risk? Well, credit risk is basically the possibility that if you lend money to someone, that person might not pay you back. So if you lend money to someone, you can think of that as a default option. They have the option to default, the option to decide they'd rather not pay you back. And the reason that you earn interest above, say, a risk-free rate is essentially to price in that option. So you charge someone more money, and the riskier they are, the more interest you charge them to cover the risk that they might potentially not pay you back. So credit risk is the risk that this default option will be exercised. Okay, So what kind of instruments have this kind of credit risk or option embedded in them? Well, there's actually quite a few. There's, of course, the usual bonds. So corporations issue bonds, particularly larger corporations issue corporate bonds, but governments also issue bonds. So there's sovereign bonds. Biggest market in the world is the US Treasury market. So US Treasury market is issuing debt, and it is conceivably possible that they might default on that bond. So they could decide not to pay that bond. So there's a default possibility there. Municipals in the United States, there's something like 80,000 entities, such as water authorities, sewer authorities, local governments, state governments, city governments that all issue debt, they issue bonds. So there's a huge municipal bond market in the US. Regionally, it's very different how countries manage that kind of financing, but there are a lot of local government bonds available. So those kind of bonds. There's also loans, so banks make loans to corporations, and then also they securitize them. So if you're familiar with a CLO or a CDO, it's where you arrange a deal where you get maybe 200 loans put together and securitize them and sell off tranches or pieces of that pool. So those are also debt instruments and depend on the likelihood that those underlying loans default, and then you can estimate what's the likelihood that those tranches or divisions of that pool also default. Another huge area of debt is consumer asset securitization. So credit cards, auto loans, student loans, basically anything that there are loans that can be pulled together, those can be put into a giant pool and then divided into different layers of credit quality called securitization. And that's actually a large emerging trend going on now in China to take a lot of the consumer lending and securitize that and find buyers for that kind of lending. So it's something that's very efficient for banks to do to be able to reuse their capital. Because if you tie up all of your capital as a bank in lending out, then you can't make new loans. And many banks make much of their profitability through the origination process. So they'd like to be able to continue to make more loans and more loans. But the way they can do that is selling off those loans into securitized packages. But of course, there's that credit risk because there's some probability that those things won't pay back. And that's the question of what is that risk. Real estate, another huge area. Commercial real estate, residential mortgages, very often are securitized for the same reasons. Then, of course, with derivatives. So even if you're talking about interest rate swaps or any other derivative you might have between large banks or other counterparties, there's some risk that the counterparty might default. And that's credit risk that gets embedded into the derivatives and swaps and so forth. So there's a lot of credit risk, and that's in fact, since the financial crisis of 2008, become a huge area of concern as to how to model that and how do you capture that kind of counterparty risk. So in quantitative finance, there's become a big growth area of covering things like CVA, DVA, FVA, all these different value assessments of how much risk there is and how to take into account counterparty risk. So there's a lot of work on that also in terms of how you capture that risk, which is essentially credit risk. So in other words, if you have your swap, what happens if your swap counterparty doesn't pay you back, particularly if part of the swap, you're in the money, they owe you money, and they default. So how do you account for that risk? And finally, another example, there's a lot of insurance-linked bonds. So insurance companies insure things and then securitize that and solve those bonds. So there are a lot of catastrophe bonds, for example, that cover hurricane risk, earthquake risk, you name it. Okay, so all those things are considered credit instruments, and when you sell them, then there's always this possibility that somehow something might happen that would cause that bond to default. And again, default means if you're supposed to have timely payment of both interest and principal, anything that would cause it not to make that timely payment. Okay, so in this graph, we have sort of a comparison of two views of credit risk. One is from the risk management side and one from the pricing side. I thought this might be helpful to just get a sense for how the two compare. Again, risk management is more dealing with the actual likelihood of an event occurring and how to assess that risk, whereas pricing has to build in risk premia and how much you should get paid for taking on that risk. So so very often that's thought of as being risk management is in the real world and pricing is in the risk neutral world. Okay. So in terms of risk management, very often you get relative default risk categories, which are ratings. So of course you get rating agencies like Standard & Poor's and Moody's that issue ratings, but there's also every bank has its own internal rating system, and when they make loans, they also rank. And typically they'll use either 10 or 20 categories of different degrees of risk. And in the same way that Standard & Poor's has a rating scale that goes from AAA as the safest to CC as the riskiest. And you end up with roughly 20 different categories there also. And one interesting thing to note is that risk tends to grow kind of exponentially as you go from AAA to AA to single A to BBB and so forth. As you get riskier, it grows exponentially. So at the very high end of the spectrum, you have very, very low risk. You might have something that's like 1 in a 10,000 type scenario. Next category might be 1 in 5,000 or 1 in 2,500. But once you get to the riskiest category, it's maybe a 50-50 chance that those are things extremely distressed, and that depending on what happens, it's very likely that it may not pay. So you go from something that's 1 in 2 to 1 in 10,000 is the scale of which these rating categories typically play out. So, but that tends to be more, these rating risk categories tend to be more qualitative and kind of a fundamental analysis of what's the relative risk compared one to another. There's also a much more quantitative approach, which is typically done through probability default. So these are actually models that attempt to capture the real world probability of default over some time horizon. That is, the probability this default option would be exercised. And that's a PD model out to some time t that's based on information from today, historical information, and various factors. So I've illustrated X naught is the information you have about a company or anything else, economy and so forth, at time 0. And this is the probability defaulting in this time horizon, capital T. Okay. Just for completeness, that's not the only type of credit risk or factor that's important, though, because beyond just the likelihood that it's default, the question is, okay, if a default occurs, how much would you get back? How much would you recover? Because when defaults occur, you don't necessarily lose everything. And that's where the concept of loss given default comes in. So how much do you actually lose on a bond if the default occurs? And that's also a very important concept. Sometimes when a default occurs, you actually recover fully. It's just maybe a matter of timing. Or sometimes, say it's a company that just goes completely bankrupt, has no assets, and you lose everything. So it can be anything between losing everything to recovering fully. So that's another important thing to consider. Exposure at default is also an interesting concept, which is when banks make loans, oftentimes what they do is credit lines. So a bank will say to a company, okay, you can draw it down, we'll make $100 million available, with the anticipation that they'll not necessarily draw all of that 100 million. And the idea is, as the firm gets riskier, the bank's going to monitor that and maybe cut off that credit line. So the question is a firm becomes riskier and riskier and then goes into default, how well is the bank able to manage that credit line, and how well are they able to limit how much their exposure is? So the question is, when you make a credit line available, what's the potential exposure at the time of default, and how well is a bank able to manage that? So that becomes another important modeling factor. And finally, from this risk management perspective, probably the most important thing to put together is how does a portfolio and what are the losses on the portfolio? Because in the end, no bank and no one ever only invests in one firm or one bond. No bank only lends to one company. You lend to an entire portfolio, you get diversification that way. And so the question is, if you're a bank and you're loaning to 100,000 different obligors, what kind of losses might you incur from all those loans you're making? And obviously it depends on the probabilities of default of each of the individual obligors, it depends on their recoveries, it depends on the exposure at default. All of these things go in, but most important, or not most importantly, but one of the key factors also there is how correlated, or what's the likelihood of these companies and all these people you're loaning to defaulting at the same time or in the same period. And that's very much driven by the idea that these defaults aren't independent. They're driven by what's going on in the economy, macroeconomic factors. They're driven by all sorts of things that drive recessions. And so how correlated are they? How likely are they to default together or in the same time period is a really key question. And how well are you able to diversify your portfolio and manage that correlation? So that becomes a really important aspect of managing a bank portfolio. And how well you're able to manage that is reflected in how much capital the bank needs to hold. So capital is a function of the riskiness of the people you're loaning to, but also how correlated they are. So that becomes a very important aspect of modeling credit risk for portfolios. Okay, and then just say a bit on the pricing side. Usually the risk is captured through pricing through credit spreads, which is basically how much spread or how much addition you have to pay beyond the risk-free rate to borrow. So the riskier you are, the wider your credit spread. If you're a very safe company, AAA or AA, maybe you only have to pay a few basis points over the risk-free rate. But if you're a very risky company, you might have to pay 1,000 basis points, something 10% more than the risk-free rate if you're going to borrow. So generally what you see in terms of credit spreads is as a company gets riskier and riskier, their spreads start to widen, and that corresponds to the yields going up and the price falling of the bonds. Okay, so that's how it's measured. In terms of bonds, typically the way you get to a spread is what's called the option-adjusted spread, because another factor of bonds is they tend to have a lot of optionality embedded in them. And so there's all sorts of different types of options that can be put in, including the right to prepay bond, things like that. So usually what you try to do is strip out that optionality and get to what's called the option-adjusted spread, which is just a measure of the credit quality loan or the likelihood of default associated with that bond. And associated with then those spreads or credit spreads is the probability of default, but now this is frequently referred to in terms of a risk-neutral probability of default. So there's pricing formulas for the cash flows of bonds, but if you want to price it, then you use this risk-neutral probability of default. And what that reflects is, it's a bit of sleight of hand, because what it's actually trying to capture is everything that goes into the price of a bond, and representing that as some kind of probability of default. But it's not actually a real probability of default, because it also represents liquidity, it represents supply and demand, it represents anything else not default related. And in fact, that can be very often the dominant part of the credit spread, or the probability, risk-neutral probability of default is in fact things that aren't related to default. So it's a little bit confusing when you see people talk about risk-neutral probability of default. Very often that probability of default is really not related to default at all. It's just a way of thinking about what's the price of a bond. In the same way, you have loss given default for pricing purposes, but again, it's a kind of a risk-neutral loss given default. It's kind of a market view that embeds market risk premia, as well as all these other things that might concern the market's view of recovery. And finally, from the equivalent of the portfolio loss in the pricing world is what's called implied correlation. So a lot of times, if the market prices a securitization or something that depends on the portfolio and the correlation within the portfolio, they might add a risk premium to that correlation. You end up with something like a view from the market pricing that they're paying for that risk and that correlation risk. It changes the correlation or the dependency of those joint defaults from what would actually historically happen. So again, you get kind of a risk-neutral view of correlation on the pricing side, as well as different from on the risk management side. Okay, so and that's our brief overview of credit and the background of it. So now I want to go into a bit more narrow area of credit. So that was the big overview of credit. Now let's talk specifically about PD models. So PD, again, is probability of default. Okay, so now we'll get into a little bit of math. Okay, so one of the classic models for coming up with the probability of default is called a structural model, which was originally pioneered by Robert Merton and then was further developed and commercialized by a company called KMV, which is where I used to work. And what it says, it's based on the concept that KMV pioneered called distance to default. And what it says is for publicly traded firms, you can view the equity of the firm, so the stock and market cap, as a call option on the fundamental value of the firm or the asset value of the firm, where the call option's strike price is the face value of the debt or the default point. So essentially, you view this as if you hold the equity, you're not at any risk for losing anything. When the value of the equity could get to zero, but you don't have to pay any of the obligations of the firm. If the firm defaults, your stock goes to zero, so that's like the option being out of the money and expiring out of the money, but you're not liable to pay for any of those debts of the firm. So in that sense, the equity is a call option on the value of the firm. If the value of the firm falls below the level of debt, it's just worth zero. So in that sense, the payoff's like a call option. And the way this is valuable, this insight is valuable, is what this does is it allows you to use the market cap or the equity price to imply out what the asset value of the firm is, so how much the firm is worth. And that's usually something that's not that transparent, because the value of the firm is essentially the value of the market cap plus the market value of the debt, but it's really hard to tell what the market value of all the debt and so forth is. So this is a way to let you imply out from just the equity pricing what the value of the firm is. And then you can compare that to the face value of the debt and get a sense of how far is the asset value above the value of the debt, and therefore how safe it is. So the higher the asset value of the firm above the level of debt means the safer it is. On the other hand, the industry and the volatility of that company is extremely important that also. So if that asset value is extremely volatile, then it's riskier than if the asset value is very stable and very low volatility. So that's another key factor in determining this riskiness of a company for default. And that's where this concept of distance default comes from. It's basically a ratio, kind of the return of the asset value divided by the default point, scaled by the volatility of the asset value, and times the time factor. So this is a statistic called distance default, and the bigger the distance to default, the safer the firm. Okay. So the original Merton model was an attempt to use this insight of being a call option on the value of the firm to get a sense for how much the bond should trade at. And that didn't prove to be particularly successful for various reasons. And no one was really that able to make use of it in a really commercially productive way to get insight from this model, not for pricing nor for risk management, until KMV came along and said, okay, well, this makes a really great statistic that helps differentiate riskier firms from safer firms. But if we can actually add that to historical default data, we can figure out how to map this statistic and figure out what that says about the actual probability of default by calibrating it to historical data. So we can get all this historical data in companies, see which ones default, and figure out which sort of state of the world, what distance default corresponds to what default probability. And that led to an extremely successful way of viewing it, in a way that kind of fundamentally changed how people thought about credit. Because prior to like 1990, no one really did modeling of credit and of probabilities of default. This was all a very fundamental analysis, understand what the company's doing, understand what their management is, look at their financial ratios, but ultimately come up with your assessment in a very fundamental analysis way. And this was one of the first models to really be successful at predicting what's the probability of default. And again, it's all stemming from the equity market. And what's the insight there? Well, the insight is equities trade a lot. There's a lot of analysts, a lot of equity analysts looking at companies. So through this statistic, by looking at the equity markets, you're already getting a huge amount of insight and market view on the quality of the company. And if you can back out this, then that's taking all that analysis that's going on that's determining the equity price and the equity volatility, and using that to ultimately give you insight into the credit quality of firms. And these models have proved to be very successful and quite good at differentiating which companies are riskier and which are safer. A downside of it is also, though, it tends to be a bit volatile. So you can have views of credit quality kind of fluctuating as equity prices fluctuate. So it's not a perfect measure, but on the other hand, there's a lot of insight that we gained from this kind of market-based credit measure. So that's kind of the original structural model approach. The reason it's called structural is because it's based on this concept that you've got a firm and it's got a market cap and debt, and you're doing it based on the corporate, the structure, the capital structure of the firm. Another approach which gained a lot of interest starting in the mid-90s is what's called reduced form models or default intensity models. And the idea behind that is, well, you can think of having this intensity default, which is sort of it's often called a Cox process or a doubly stochastic process. We have some stochastic default intensity model, and then that evolves, and at a certain time there's a jump to default, or an instantaneous default probability, which is captured by this lambda intensity times delta t. And so if you put that into a probability framework, so the probability of defaulting up to time t can be represented in this way through this formula by integrating your intensity from time 0 to time t and the exponential of that. So the instantaneous default probability becomes lambda, and this gives you then a view of going out through time. And then you can come up with stochastic processes to describe the evolution of the lambda, this intensity model, and it becomes similar to interest rate models. So you can think of your stochastic interest rate model evolution models that then lead to bond pricing formulas that look something like this for like treasuries, things like that. The reason it's called reduced form is that a lot of times these models don't attempt to impose this kind of corporate or capital structure of the corporation on what causes the default. They're not trying to explain what caused the default. It's just coming up with some market measure to say what's the intensity of default. So that can be driven by a lot of factors, but it's not trying to impose any concept of what's driving the default from its structural formula. Okay. So there's a lot of models that are based on this, and I haven't really said anything about how you modeled this, but that can be based on a lot of different factors, and it can be based on macroeconomic factors, company-specific factors, the evolution factors, and there's some very sophisticated models out there that have developed this concept of how you build up a model for your default intensity. Very closely related to this in a more or less time-dependent fashion are regression models, and very often there are logit or probit, et cetera. So this is just a basic logit type model where you say your probability of default has an expression like this, where you've got, say, a constant plus this x represents a bunch of potential factors that could influence for a company its likelihood of defaulting over next year. And that would be things like financial ratios, so how much debt the firm has, so earnings over debt. It could be variables related to the market cap, or very often distance default is one of the variables that goes into this. So this could be a statistics that's used in a model like this. There could be liquidity measures that are put in. You get various variables that go into forming this kind of model also. So this is probably, I'd say, the most common now of the basic PD models. But again, very often, if distance default for publicly traded firms with publicly traded equity is then included in this kind of model as one of the many factors that go into predicting default. Okay. So this is just a brief overview of some of the kind of corporate PD models that we deal with. And I want to say a little bit about what the modeling process is, because it actually can get quite complex. And the reason for that is that ultimately these models need to be calibrated to historical data on what characteristics describe firms that are more likely to default and what characteristics describe firms that are less likely to default. And default occurs, it's not like, it's very different than equity modeling or pricing equity options or anything like that. We have a lot of information. You get tick-by-tick trading. You've got huge amounts of very recent data to build off of. Defaults occur on a much, much slower time scale. A firm might not default. If it does default, maybe defaults in a year or in 2 years or in 3 years. So the number of defaults you have in a data set may be quite low. And a typical investment grade corporation might only have, say, a 0.25% chance of defaulting over the next year. So that's pretty low. And even sub-investment grade, very often it's maybe you're talking about 1%, 2% chance of defaulting. So you don't, if you have a large population, say you have 1,000 firms in your population, you might only observe a few defaults every year. 20 defaults a year, so forth. So it's a relatively rare event, so that also makes it difficult to build up a data set large enough to describe what differentiates firms that are going to or likely to default from firms that are very safe. So that's a big challenge. You need to collect the data, and you also need on the firms as well as market data. This also can be very challenging if you're going into an emerging market or a new market. So for example, say you want to build a model like this for China, that could be extremely difficult to collect all the financial data on Chinese firms. Maybe the banks who are loaning aren't really keeping that, or they're not keeping it in a standardized form. It's also not actually that clear as to whether firms default or not. Particularly in China, the government owns a lot of the firms, or has a lot of interest in the firm and prevents it, or will provide liquidity to keep firms from defaulting. So that becomes another question. How well do you know the data? How well can you analyze the data and really decide, was this a default or was it not a default? Same problem with, in the US, in the banking industry, during the crisis, how many banks actually defaulted and didn't default? Well, there's one obvious big one, which was Lehman Brothers, but there were a lot where the government stepped in and prevented a default or brokered a sale or forced a sale. So Washington Mutual did not default, but it was under a forced acquisition. If the government hadn't stepped in, Citibank might have defaulted. So it's hard to say, was that a default, was it not a default? So there's a lot of conditions on identifying whether things are really, was a default, not a default. And particularly as you get into smaller firms, it becomes also a bit challenging to know. If you look at historical data, you may see that the firm just doesn't exist anymore. Does that mean they defaulted, or does it mean they were acquired, or does it mean they just paid off all their debt and kind of disappeared? It's not that clear. So it takes a lot of work to very carefully produce a really high quality default data set. And that was one of the things that made KMV very successful, is they spent a huge amount of resources collecting and cleaning that kind of data. So that's a very important aspect to building a default model, or a PD model. So you want to capture the company's specific financial ratios, debt levels, liquidity measures, macroeconomic and market data, equity prices, if you have that, volatility, stock rank index for the whole market. And you also tend to need very many years and many firms in order to build a model, because again, the probabilities of default may be relatively low, so you just don't have that many default events to calibrate to. So once you collect the default data, then you also need to tag each one, and this goes to identifying the defaults. Either tag it as a survivor or a defaulter. And this can also be a bit challenging for the modeling, because any firm that defaults now, obviously, if it didn't default in the previous year, and the previous year, and the previous year, but usually you'd consider these as kind of year-to-year independent observations, even though there's, if it defaulted now, it didn't default 2 years ago, you're going to take its information from 2 years ago and include that in your data set, as if you didn't really know that when it was going to default, even though that is in your data set. So tracking that dependency is very hard to really capture correctly in these models. But ultimately, that's what you want, is to tag for each observation. Typically, you do it at the beginning of a year, or whenever the firms release their financial information. Sometimes it's quarterly, sometimes it's only annually. Grab that information and then look to see, based on the financial ratios, the financial information, did it default in the next year or not? And it becomes a 1-0 type thing. Okay, next thing you need to do is construct which factors you're interested in. So you may have collected a lot of information, but typically you deal with financial ratios. You have to decide which ratios you want, which may be interest income divided by debt level, all sorts of things like that. So you have to decide which are the factors you want to consider and which ratios you want to construct. So you need to do a lot of work there. And then the next thing you do is you need to somehow scale these factors in some way, or decide what you want to do so that they actually become comparable. Because if we go back to a formula like this formula, you see you're adding them up. So to avoid sort of instabilities in estimating what these coefficients, these beta coefficients are, it'd be good to have the x's all on more or less the same scale. So you want to figure out what's the right way to scale your data. Very often, a simple thing you can do is simply rank transform the variables to put them on a scale between 0 and 1. That's a frequent thing to do. So you need to decide your scale factors. You may also want to scale them in a way that focuses more on one specific range of that variable. So for example, you could realize that certain variables are kind of irrelevant for predicting default unless they're above a certain threshold, in which case you may transform them in a way that focuses more on that range of the variable. Okay, then you want to calibrate the model, which means first you have to decide which factors you're going to use in your model. So you have to have some way of deciding what's the most important factor, what's the next factor you're going to add. That would be what's called a greedy forward type approach. You can also take all your factors together and decide, okay, if I use all of them now, which one, if I remove one, which would be the least significant to remove. Because ultimately, it's not that great to work with a model that has, say, 60 or 100 factors, because they tend to be very overlapping, they tend to be very collinear, and produces a model that's not very stable. So you'd like to do some kind of factor selection approach, and usually you have too many factors that allow you to take every possible combination and sub-combination of factors. It just becomes computationally impossible. So you have to have some way that you decide which factors you're ultimately going to use. You have to have some way to calibrate the parameters. That is, how do you estimate, if you decide a model like this, how do you estimate these coefficients, which is basically you're doing some kind of maximum likelihood estimate versus your data set, which is ones or zeros. Did it default or did it not default? And then ultimately you decide how, whether you want to include a factor or not include a factor is typically based on out-of-sample evaluation. And the problem with out-of-sample is, again, because you have typically so few defaults, you don't really like to exclude defaults from the set you're calibrating your parameters to, so you need ways that allow you to use the data as much as possible and still make out-of-sample decisions around whether to include parameters. Okay. And then finally, and this is really the important thing I want to talk about now, is how do you measure performance of your model? In other words, how well does the model differentiate defaulters and survivors, and how well does the model fit the observed data? So what are the performance measures for your model that you're going to use to decide how well you're doing? Okay. So here's the sort of philosophical slide. So what makes this a difficult exercise, and what makes it difficult to measure performance? First, there's the data problem, getting clean data, and also the fact that defaults are relatively rare. So it's not like doing risk management for equities where you've got tick-by-tick data, you've got a ton of data, you can really build models, you can build stochastic models and so forth. You've got these rare events, and so it's very hard to get enough data to really calibrate well and then really test and do a lot of out-of-sample testing and so forth. So that's the fact that defaults tend to be rare is good, but on the other hand, it's not so great for building a model. Okay, other thing, finance isn't physics. So if you worked in quantitative finance long enough, you'll notice that there's no fundamental rules. I mean, the most fundamental rule is no arbitrage, but even that's not really true. So as we see, in high-frequency trading, people have faster access to information, can make money off of that. So there's no universal law that says for certain that this relationship of predicting defaults has to be constant in time. So if you're using a 10-year data set, are you really sure that that data and those relationships that you're getting out of analyzing the data really holds true now? Has something changed? Did the financial crisis fundamentally change how a market operates, or how what kind of companies are getting loans now, and are those companies behaving differently than what was 10 years ago, things like that. So the weights on your factors, what factors are actually relevant, may actually change through time, or may be different during your calibration period from what you're looking at now. So that's also a challenge. And then here's the philosophical question: is there really a true probability of default that you could actually know? So what I mean by that is, we'd like to say we've got a model that measures the probability of default, but what are we comparing our model to? Is there actually a true probability that we could say, this is the probability of this firm defaulting in the next year? Because there may not be a knowable probability measure associated with the future events that we could somehow calibrate to. For example, suppose the European Union were to break up. What would that mean for different countries defaulting, or the debt of corporations in Italy being issued? That could be an event, but we have no way of assessing what first the probability of that event really happening, and what's the impact on companies defaulting in those countries if the currency union breaks up. So it's really hard to know what is the true probability. There's a lot of factors that you might not be capturing because they're not in the historical data you're calibrating to. So first, it's not necessarily clear that there is a true PD that you could know, And then that means it's not very easy to say what my model PD is compared to the true PD, because you can't really know what the true PD is. So that's a problem with coming up with ways to evaluate how well your PD model works, because you don't know what to compare it to. Finally, and this is really a big deal, is that the correlation, the fact that the underlying factors that are going into establishing the riskiness of or safeness of firms are generally correlated. So all the macro variables tend to be correlated, and those are driving your model. So when you're doing and looking at all these defaults that occur in your data set and how well your model predicts defaults and differentiates defaulters from non-defaulters, very often the statistics that are being used for these performance measures implicitly assume independence of your observations, but they're definitely not independent. So that becomes another challenge, is when you use the statistical measures to evaluate the performance of the models, just keep in the back of your mind that these things actually aren't independent. So you need to try and take that into account, but it's very hard to take it into account because you don't really have a clear picture of how they're driving the performance. So that's just another challenge to making what's difficult to build the models, and also what makes it difficult to evaluate them and how well they're working. Okay, so let me say a bit then about what are some of the standard ways of measuring performance for these PD models. Okay, so there are sort of two flavors, and I'll talk about the first one is more fundamentally data-driven, and really asks the question, how well does my assessment of the probability of default differentiate defaulters from non-defaulters? So it becomes a kind of classification problem. How well did I classify those that eventually default and separate those from those that don't default? And these tend to be relatively simple measures, and they're also nice in that they give you a number. So the number is usually between 0 and 1, and so in this case it's called the accuracy ratio. So that goes from 0 to 1, and if it's a score of high like 0.9 or 0.8, you say, well, the model is doing really well. If it's close to 0, then that's a really poor model. At least that's how it's quoted. So something like 0.9, 0.95 would say, I've really separated the ones, my model was able to separate the names that are going to default very clearly from the names that don't default. The second class are more statistical models that are like likelihood estimators, or based on chi-square tests for likelihood ratios, likelihood ratio test or chi-square test for goodness of fit. So I'll talk about those in a moment. But first, these classification measures. So accuracy ratio, basically you sort firms from riskiest to safest based on your credit model. So when we've got to go from 0 to 100%, this is the 100% of the obligors, with these being the riskiest at this end, and these being the safest. So if you have a probability of default model, the names that have the highest probability to default model gets rank ordered through to the safest, lowest probability of default. And on this axis, you plot the percentage of all defaults that are captured by those names. So if you have a perfect model, what you'll get is a straight line where you capture all the defaults. Every name up to here defaults. So as you go up, and you eventually get to 100% defaults, and after that it just flatlines out because you've already captured all the defaults. So a perfect model that's completely separated everything would put all of your defaulters as the riskiest names, and all your non-defaulters would be then rank ordered as the safest names. Okay. A completely random model is this line here, where your likelihood of defaulting is just the same as whether you've been rank ordered at the safe end as the riskiest end. So if you just flipped a coin or randomly assigned a probability of default to your sample, then the curve that you would get would be something like this diagonal line here, right? So there's no differentiation of performance. And a typical probability of default model falls somewhere in between. So it's not perfect. You're not able to completely separate and absolutely say only the riskiest firms default. But on the other hand, it certainly should work better than just randomly assigning probabilities to your sample. And then the measure, the accuracy ratio, is basically the area under your model relative to the area under the perfect model. Okay. And that goes from 0. So if your model is really bad and it's basically the random model, that gives you a 0 value. And if your model is perfect, then that gives you a value of 1. Okay. Same way, there's very similar concept of what's called receiver operator characteristic and the curve and the area under that curve. And what that means is you're basically, again, separating based on your rank order, your credit rank, and you're trying to see, for any given level, see how well did you separate your defaulters from your non-defaulters. So you have a cutoff, and you basically see what percentage of those that default are less than that cutoff, and what percentage of those that survive are greater than that cutoff. And this allows you to compare type 2 to type 1 errors. In other words, an incorrect decision means that you survive even though you were below the cutoff, that it means you were riskier, or you survive, or you said it was a survivor, that means it's greater than the cutoff, but it actually defaulted. And then you've got your correct decisions. Okay. So you can define from this concept what's called the true positive rate, which is basically the percentage of defaults that have the PD above the cutoff divided by the total defaults. And you've got your number of false positives, which is the number of non-defaulters that were above the threshold divided by the total number of non-defaults. And then you can plot this as a function of this threshold, this cutoff C, as C goes riskiest to safest. And that plot is called the receiver operator characteristic curve. So it usually looks something like that. And then the area under that curve is the measure. And that area under the curve, which can be represented as this integral, becomes your statistic. And again, this number goes between 1/2 and 1. So for a perfect model, it would look like this green curve, and you get an area underneath here is 1. And if it's a completely random model, you just get this line, and the area under that is 1/2. So the ROC, or the area under that curve, goes from 1/2 to 1. Turns out that these are actually the same measure if you assume that type 1 and type 2 are equally weighted, because the accuracy ratio is just 2 times the area under the ROC curve minus 1. So actually, even though they're slightly different concepts, they're the same measure as long as you assume type 1 and type 2 are the same. Now, of course, in credit, as in this example, eating mushrooms, type 1 and type 2 can be very different. I mean, your risk of eating a toxic mushroom and dying is, you may consider that quite different than the risk of throwing away a nice edible mushroom. So in the same way, loaning to a firm that defaults, you may consider that very different than the risk of not loaning to a safe firm, a firm that doesn't default. But in practice, usually the ROC, or the area under the ROC curve, and the accuracy ratio are treated as essentially equivalent through this formula. Okay, so that's the one area, or one way that people typically assess this. And this accuracy ratio, or ROC number, are extremely commonly reported for PD models. And people like to give ranges and say, my PD model, if it has an ROC above 90, it's a really good model. 80 to 90, it's 90%, it's a pretty good model. 70 to 80 is an acceptable model. Below 70 is not good. They have ranges like that. But what I'll show you in a second is why that's not really a very good way to evaluate PD models. And actually, these measures are much better for comparing model A to model B than in any absolute way. Okay, so the other way to assess credit quality are likelihood and goodness of fit measures. So the likelihood, or the log likelihood, can be written in this way for a PD model, which is basically separating the names that default and those that survive. And you add the log of the PD for the names that do default, and you add the log of 1 minus the PD for the names that survive. And what that does is, so PD is between 0 and 1, so this will be negative, but the less negative, so the largest value of L will come if all your PDs are really large for the names that default, and they're really small for the names that don't default. So again, do you get separation of the names that default from the ones that don't default? So that's the log likelihood. And you can use that in things like the likelihood ratio test, where if you have two models, you can take the difference between their likelihoods. And that statistic is a chi-squared statistic, so you can do tests to see, are they actually different? Is one significantly better than the other model? Same way you can do a goodness of fit on this, which is called deviance. So basically the statistic minus 2 times this likelihood is also chi-squared distributed. And you can ask the question, does the model fit the data doing a chi-squared type test. And there's actually straight chi-squared test where you can say this is a chi-squared statistic. Again, very similar concept of taking the defaulters versus the non-defaulters, adding this up and doing the chi-squared statistic on this. Another one is called the Hosmer-Lemeshow test, which is basically, this is doing things a little bit differently, where this is grouping into bins, so you get G different groups or G different bins, and within each bin you take the average PD or the average probability default for that bin, and you compare that to the observed number of defaults in that bin times the expected number of defaults in the bin and scale it by the volatility or the variation there, add that up, and again that has a chi-squared statistic. So these are some other more statistics-based approaches. But again, the challenge here is what we're really comparing to is, did the name eventually default or not? And how well is our model able to separate defaulters from non-defaulters? So these tests are all going to perform well if your model did. And if your model didn't really differentiate the names that default from the names that don't default, then you don't really get as good a performance, or your likelihood is much lower, things like that. Okay, so the problem with this is, with both the accuracy ratio or ROC and these tests though, is it depends a lot on your sample. If you have a sample where you have a lot of defaulters that were significantly different than the non-defaulters and your model is able to pick it up, that'll look good. But suppose your sample has a lot of homogeneous firms that all look pretty similar. It doesn't mean your PD model is wrong. It just means your sample didn't contain a lot of different firms. So ultimately, these measures tend to measure more how variable was your sample, not the quality of your PD model. Right? So you can have a model, for example, you could have a sample where every name in the population has exactly 1% chance of defaulting. And that could be the true model. The PD could be exactly 1%. If you put that in to these tests, and then in fact that was the result, you'll find that these models perform terribly because they'll look like they can't differentiate who defaults from who doesn't default. Right? Well, of course they can't differentiate it because there is no difference in terms of PD, but it doesn't mean the PD model itself was incorrect. So that's the challenge with these models, is they tend to favor data sets where you have really big differentiation between the characteristics of the firms. And that's where it gets a little bit risky, because then you can start to kind of game that by throwing in names that are really risky into your data set, or to make your model look better just by selecting what goes into the data set you're evaluating. So in the end, what we really have is something that's more a statement about the data set and less about the model. And what we'd ideally like is to be able to say the performance of the model. In other words, if you had a true model, you'd really like that to perform well in these tests. And as I'll show you now in evaluating these performance measures, even if you have a perfect model, can give you very bad results. Okay, so let me show you that with this calculation. So in order to compute the accuracy ratio, again, that was the accuracy ratio, let me remind you, is where you plot the risk. So you go from the riskiest to the safest ordering, and then you count the percentage of all the defaulted obligations you capture by rank ordering this way. So if you just work out the basic math of that, rank order your with PD, so your riskiest, highest PD down to your safest PD. M is the number of defaulters, where XI is a 1 or 0. It's a 1 if it's defaulter. So M is the total number of defaults. XI is default or no default. This becomes the y-axis. It's just the percentage defaulters you've captured as you go up to the ith name. And you can work out pretty easily. It's just the integral under that curve. So using like a trapezoid type rule, you can come up with this formula for what the accuracy ratio is for n firms. Okay, so this is the area under the curve, and this is normalized by the perfect model. So if all your m defaults occurred in the first m names, this is what you get for the denominator. Okay, so that's a simple formula. And if you do a little bit of arithmetic, you can rearrange this. So this is just the same formula, except now you see m over n is essentially your default rate. So it's the percentage of names that default in your sample. So you get the default rate up here and also in the denominator. And this thing is starting to look more like an integral, right? So 1 over n sum n. So you think of this as kind of an integration. And now what I want to do is start thinking about what happens if I take the limit as I get n going to infinity. Okay. Well, now that we have to be a little bit careful about what we mean by that limit, because we've got a finite data set. What's more, we've rank ordered the names in the data set to riskier to safer. So exactly what does it mean to take a limit as you get more and more data? And that's what I mean here. So what I'm going to do is assume that, in fact, all of my PDs and my functions, I'm going to assume that there's a distribution function f of PD. So I can have, when I observe something, that I can think of that as being sampled from the distribution. And the data set is considered a set of samples, sample PDs coming from this distribution. And I'm going to assume also that they're independent IID. And from that point of view, I consider my PDs to be random variables. So I've got a distribution, probability distribution for these PDs. And I'm going to consider them random variables. And in order to connect this back to this formula in the finite data set, I'm going to have to make one key assumption, which is I'm going to assume that the sampled PDs are in fact the true PD. That is the actual true probability that a name is going to default. So the probability that the issuer defaults is exactly PD. So that means this variable xi, which was 1 if it defaults and 0 if it doesn't default, can actually be considered a random variable also in the expectation of xi, which is 1 or 0. In expectation, it's just pdi. And then if I somewhat carefully take the limit, I can see that the ratio m over n just goes to the average PD, that is the expected value of PD, which is PD integrated against this distribution function, which by integration by parts can also be represented as just an integral of the distribution function. So that's the m over n part. And if I work with the rest of the formula, I can come up with this result, that the limit is the number of observations goes to infinity, and this is a true PD model. I get this formula, which with some calculus very nicely reduces down to this formula, which contains only the average PD, which is the integral of f, the distribution function, and the integral of f squared. Okay. So what's nice about this is it's extremely well behaved, because f is a cumulative distribution function, so it's between 0 and 1, and it's a very nice thing to integrate. And it works well, and it's also really easy to calculate. So this gives you what you're limiting large sample. Don't have to worry about too small a sample. We're assuming there's an infinitely large sample of true PDs. But it also points out something which is kind of the key observation, which is this limiting accuracy ratio performance measure depends only on the distribution of PDs. Okay? In other words, it doesn't depend on the quality of the model, because the quality of the model is assumed to be perfect. The PDs are perfectly predictive. They are the true probability of default. But you get a very different accuracy ratio depending on what your distribution of defaults in your sample is. Okay? So in particular, one more set of observations, connecting it back to the finite sample. Again, assuming that you've got a true PD model, then if you have a finite sample, the expected value of your finite accuracy ratio is just the limiting case plus an order 1 over n error or term. And the variance, again, goes like 1 over n. So in fact, even though you say, well, the infinite sample doesn't make that much sense, that's not realistic, any finite sample, as long as it's a true PD for a finite sample, the expectation of that is this limiting accuracy ratio. So the limiting accuracy ratio actually is relevant or meaningful even if you have a finite sample. And if you wanted to, you could also compute the full distribution through simulation. Okay. But the conclusion is that even for a perfect PD model, you're exactly getting the probability of default. As a performance measure for the model, the accuracy ratio first is sample size dependent, but it's the estimate of a quantity that depends only on the nature of the population, not on the quality of the model. Ideally, if your model were perfect, you'd like some measure that said this is a perfect model. That is not what this accuracy ratio gives you. And a couple of special cases to really highlight that. Suppose you have a point mass at, say, 1%, then the accuracy ratio is 0. If all your names in the sample have exactly the same probability of defaulting, as I mentioned before, you get no differentiation. You can't tell which ones are more likely to default or not. It's not a problem with the model. That's the issue with the data set. But the accuracy ratio, which is used to describe the quality of the model, says it's 0. It's a bad model, even though it's a perfect model. On the other hand, the other extreme is if you have 2 point masses at certain mass at 0, probability of default, that is, these are guaranteed to survive, and certain mass at 1, where they're guaranteed to default, then obviously you can do perfect differentiation between who's going to survive and who's going to default. You get an accuracy ratio of 1. So you can get anywhere between 0 and 1 for your accuracy ratio, even though you've got a perfect model. Okay, and then this is also very common that you have K buckets. So that's, for example, you think of these as rating categories, and you could sort of bucket things together and put them into K different categories. And we're going to sort these in terms of category 1 is the safest to category K is the riskiest in terms of PD. And we're going to assume that the population is weighted with weights that add up to 1. Then in this framework, then you can describe exactly this distribution function and compute this limiting accuracy ratio. So you've got a formula. So it's very easy to work with this. And this allows you to say, depending on how you choose your buckets and how you choose your weights, you can get essentially any accuracy ratio you want, which means if you choose to add a very risky bucket to your sample, you can make your model seem like it's performing better just because you added a risky bucket to your sample. And we can show that through a couple of examples. One is, here's a set of buckets that go up from a very safe bucket, only 2 basis point percent chance of defaulting, up to the 10% chance of defaulting. And if you do this, and this is a true model, then when you run the sort of large sample, essentially infinite number of names in your portfolio, even with this perfect risk categorization of PD, your accuracy ratio is about 71%, 71.7%. Okay. However, if you multiply everything by 5, so this is just now 10 basis points going up to 51 basis points, you've just changed the PDs. You haven't really changed anything about them other than the PDs are now larger. Just increasing the default levels, so changing your buckets a bit, can increase the accuracy ratio up to 78%. So again, it's still a perfect model exactly describing the true probability of default, but depending on what range you've chosen, you get different values. You can also then think about how do you optimize that. So if you want to maximize what your accuracy ratio is, assuming the same average PD, what it says is put all your names in the riskiest bucket and the safest bucket, and that gives you the best differentiation, so therefore the best accuracy ratio. Or you can minimize it, which means put everything in very similar buckets next to each other. So in other words, better accuracy ratios can kind of be obtained by increasing sampling of your 2 extreme buckets. Okay. Good. So then I also wanted to mention a little bit about the concept of correlation and how that can impact these measures too. So what I've done here is I've created, these are all different sort of separations of the buckets. In other words, 1.05 is a very, just means how much I've multiplied each bucket as being riskier than the previous bucket. So it only goes up multiplied by a factor of like 5% riskier each bucket as you go down. Whereas this is, each bucket is 2.5 times riskier than the previous bucket. So that's much bigger separation and a much wider range. So this has a very wide range of PDs in the 10 buckets. And this has a very narrow range, very tightly bunched range. But what we see is in the infinitely large pool, so this is for the limit of an infinitely large pool, if we increase the correlation of those names through a very simple correlation model, in terms of the correlation of them defaulting, as we increase correlation, for the most part, the accuracy ratio associated with it also increases. So we get the effect that as you increase correlation, you get better and better performance in terms of this accuracy ratio measure, even though, again, it's a true PD model. So we've got the model predicting the PDs is exactly correct. It's just by introducing correlation into it, again, we see an effect of the correlation on what our measure of the accuracy ratio is. So correlation definitely does have an impact on this. And in terms of actual practical application of this, there's an area where there's huge correlation, which is in securitizations of consumer assets. So for example, mortgages. If you think about securitization of mortgages, you take a pool of say 3,000 or 4,000 residential mortgages and you divide that into a different tranche. So that safest tranche, the most senior tranche, is now, the underlying collateral pool is quite large, it's been quite diversified, and so that senior tranche is probably going to be very similar to another pool of mortgages that you've securitized, and also that senior tranche is going to be very similar, and they're both going to be exposed to essentially housing risk. So if it's securitization of, say, German mortgages, then those two senior tranches are going to be really pretty much exposed to the exact same risk, and they're very highly correlated. So if you try to evaluate the performance of how well your model did on that population of AAA German mortgages, well, they're all pretty much the same bond, exposed to the exact same risks, and therefore very, very highly correlated. So the idea of having high correlation and valuing the performance means basically, if that's ever going to default, then almost all of those bonds are going to default together, and otherwise none of them are going to default. So if you try to measure PD models based on historical performance, whether they defaulted or didn't default, you have to take into account that this correlation is there and that they basically don't default independently. And that's what this graph kind of shows, is the impact of, as you increase correlation, get to very high correlations, you get a situation where it makes it look like your model is performing better in this case. You can also get in a situation, though, that if you don't get a lot of differentiation, this is now using a finite sample size, not an infinite sample size, you actually get better performance up to a certain point, and then it can fall off. So there's also actual sample size issues going on, too. I don't want to spend too much time on that. Okay, so finally, let me wrap up with a few ideas of, can we measure performance differently? Okay, so first, what are we looking for? We'd like a better performance measure for PD models that should focus on the actual correctness of the PD as opposed to estimates relative to some true PD, not be skewed by the nature of the sample population. The evaluation of the true model, of course, we'd like to say if it's a true model, it should get something like close to a perfect score, right? And also you'd have a worse score if it significantly mislabels or the almost guaranteed defaulters, the almost guaranteed survival. And actually, ideally, it would also take correlation into account. So those are sort of the wish list. Unfortunately, it's really, really hard to get anywhere close to being able to have a model to do that, because in the end, what you can observe is whether something defaulted or didn't default. That's just you can't observe the true PD. So that's what I'm going to say here. I mean, what we'd really like to have is some kind of measure between the difference between the true PD and the model. This would be a great measure, but how do you know what the true PD is? Whether true PD even exists is a question. So what you usually end up doing is getting some measure that's sort of similar to the statistic, except you replace the true PD by some kind of, its expectation is replaced by a sum over, or an average over all your observations, and it's either the 1 or the 0. So you're back to this problem of you're comparing your model PD to either 1 or to 0, whether it defaulted or didn't default, as opposed to comparing it to the actual underlying true PD. So that doesn't really get us too far. Another idea might be, well, let's consider this distribution. So we've created this idea that there's a distribution of the PDs, and then my model also could have a distribution, which could be different because my model is an approximation of the truth. And you can come up with a measure like this. Again, this is a little bit different than this, but it suffers from the same problem that we still don't know what the distribution of the PDs. You don't have to know what the true PD is, but you'd have to have a feel for what the sample true distribution is, which again isn't something that you're likely to have very exactly. Then another idea trying to capture the correlation, so this to addressing the correlation issue, is to consider your sample of defaults is not just individual independent defaults, but it's actually a portfolio of defaults. So you observe the whole sample and count the number of defaults occur in that whole sample. And that's great, that's much better, it's capturing the portfolio effect, but the problem is, in any given year you have one observation. So if you have 10 years of data, you have maybe 10 sample points. So because you've got the whole population, so you've got your, say, 10,000 firms, but you're observing how they behave together as a portfolio, so you only figure out how many of those 10,000 default in 1 year, and that's one observation. So you end up with sort of a way of capturing the correlated effects of the portfolio, but that means you get many, many fewer observations to be able to test whether your model's working well or not. So you usually end up with too few to be able to say anything very significant about the performance of the model. But there are some other ways of trying to think through, can you capture correlation? Can you build models that might be able to help you with your statistical measures that might take correlation into account? Okay. Now here's another approach that's actually very closely tied to the ROC measure with this true positive rate and the false positive rate, but thinking through it in a little bit different with the idea that we actually do have this concept of the distribution of PDs, so the true distribution function f and with the density function. And what we can define is the conditional default PD distribution. That is, you have to think about it a little bit, but the question is, what's the distribution of the PDs for those names that eventually do actually really default? Okay, so you can think of your data set, you're going to have names that default, names that don't default, and conditional on default, what's the distribution of the PDs that eventually default versus what's the distribution of the PDs that survive? Okay, and I'll show you what that formula looks like in a moment. But imagine that you have this distribution of defaulters and distribution of PDs for the non-defaulters. And again, just because something has a high PD, it doesn't mean it's definitely going to default. On the other hand, you would assume that that's more likely to default, and therefore the defaulter distribution is going to be more skewed towards that direction, and the non-defaulters would be skewed towards the safer direction. Okay. The true positive rate then can be expressed as the integral of the defaulter distribution, which are 1 minus this cumulative default distribution. And the false positive rate is related to 1 minus the distribution of non-defaulters. And this ROC measure, the area under the ROC curve, can be expressed in this way. Okay. So what's the formula? Well, if you use Bayes' theorem, it's pretty easy to show that the density function for the default distribution is just x times the unconditional distribution divided by the average PD, and the density for the non-defaulters is 1 minus x times the unconditional distribution scaled by 1 minus PD. And the cumulative distributions are given by these formulas. And therefore, you can plug this in back into our area under the curve formula down here and compute. That's just plugging that in. And if you do the calculus on this, you end up with this formula, which is actually essentially exactly the same formula that we had before, derived in a slightly different way. But again, it's dependent only on the integral of the first integral of the distribution function of PD and the square, integral of the square. Okay, so now what do we do with this? So one idea is the Kolmogorov-Smirnov test on the conditional default distribution. So given a PD model, you could either compute this if you had the PD model. So if you actually have, say, a logistic regression model and you know the distribution of the underlying factors, then you could actually compute the distribution of your PDs from that model. Or you could estimate it from your sample data, from the sample PD data. And once you're given this distribution, then you can compute this conditional default distribution. You can also, from your observed defaulters, you can compute the observed PD distribution. In other words, just take only the names to default. You've got the model that gives you the PDs. So based on only the names to default, what's the distribution of those PDs for the names to default? So you've got your sample distribution and you've got your model distribution. And then you could do a Kolmogorov-Smirnov test to compare those and try to decide, are they actually coming from the same distribution? So you've got your model-based view of default, and you've actually got your empirical data view of the distribution of PDs for default. You could ask, are they at least consistent? Are they coming from the same view? And if your model is really wrong, then they won't be consistent. If your model is actually true, then they should be, the data will say that they are consistent. So that's one idea of a way to test your model PD versus the distribution of PDs coming from your data to see if it's at least consistent. And then finally, this is a slightly different idea that we presented this problem to the Mathematical Problems in Industry workshop at New Jersey Institute of Technology this year. Had a group of faculty and grad students and so forth looking at the question. One thing they decided or came up with was this idea of using a Kullback-Leibler divergence test. So it's kind of an entropy measure, again, based on the idea, in this case, the density of the conditional defaulters compared with the density of the non-defaulters. And what the idea here is this is a measure of how different these distributions are. What's the distance between these distributions? So why do we care about the distance between these distributions? Well, that, again, was the big problem. For a PD model where everything is exactly the same PD, there's no difference between those that default from those that survive. So there's no distance there. Whereas the ones that you can sort of game and always give much better accuracy ratio numbers are where you've really separated your sample as much riskier names and much safer names together. So there you'd have a really big different distance between these two distributions. And the question is, can you use a measure of the distance between these distributions to somehow scale your performance measure and to take that into account? In other words, take your data sample, get some characteristic of the data sample that describes how homogeneous it is or how different it is, and use that as a scaling metric or something to give you confidence bounds or something, as opposed to just using the pure accuracy ratio as a measure, because we know the pure accuracy ratio will always be higher when you've got your sample well differentiated, but not saying anything about the quality of the model. So this is a way that you could add something in to help sort of try to scale out that effect and focus more on the quality of the model as opposed to the property of the data set. So again, this sort of an initial idea of something we're looking into as to how can we take that data set property into account to better focus on the quality of the model as opposed to just the nature of the data set. So with that, I will say thank you and be happy to take any questions.
I guess we have some time for questions, right? Feel free to ask. How about this? Let me ask one. You have mentioned 3 types of models for this PD, right? Do we have some conclusion about the performance of these?
Sure. Well, there's actually, in the end, a lot of overlap because the structural model is typically a factor that goes into the other models. So you could, and KMB company built the whole business of just using the structural model, but even they calibrated it to historical data. So the way they calibrated it was actually not a pure structural model. So I would say structural models, nobody uses pure structural models. They're always a factor into these other models. And then the question is, what's the sort of best way to build that kind of PD model? And that's a question of, depends on how much data and the quality of your data. If you have really, really good data, a really good default data set, really accurate data about ratios, you can do a lot more. You can build a lot more complexity. You can try to get a lot more time dependence. You can try to get sort of stochastic processes describing the evolution of intensity. On the other hand, if you're working with, say, an emerging market economy where you don't have a lot of good data on the defaults, you haven't really captured much, you don't necessarily know the quality, building in a lot of extra complexity into it may just not be that reliable. So therefore, you may want to go with a more basic logistic regression model, even though you may be missing some of the richness that might be captured in a better data set. You're not overfitting, you're not adding extra stuff that you really can't correctly capture. So it depends a lot on the nature of your data. The better quality data, the richer the data set is, the more you can do with it and the more you build in. Things that are quite apparent, though, is that you would like very much to take into account some kind of time factor. So if you're trying to build a term structure of default probability, going from, say, 1 month out to 1 year to 2 years to 3 years, the quality of the information you have today tends to decay over time, or its ability to predict default, particularly if you're talking about, say, market information like equity prices or equity volatility. The relevance of what you measure today of the equity price is going to be really relevant over the next month, maybe over the next year. But for predicting 5 years out, it becomes much less relevant. So the importance of that factor should decay through time. And so a good model should probably reweight the importance of the factors as you build out your term structure. Maybe go to a more fundamental view of credit quality over the longer term and use the market-based stuff more for informing the shorter term.
Any other questions? Well, it has been a long talk. If there's no other questions, we just finish this talk today. Thank you very much.
Okay, thank you. My pleasure.